start off by talking about study unit 1, which we said is about ethical, legal, and professional responsibilities. Now, the first thing that we're going to talk about is Circular 230. This is Circular 230, 48 pages, and we need to be very familiar with Circular 230. This is an Internal Revenue Service document. It's an IRS document, and you know the IRS is part of the Treasury Department. There's 5 subparts to Circular 230. The first of which, the first subpart, talks about the rules governing the authority to practice. So we need to know, we'll talk about this in a minute, what it means to practice before the IRS. So who could practice, for example? Can you guys practice? Do you need to be a CPA? Do you need to be an attorney? We're gonna talk about that in a minute. That's what's talked about in subpart A. Then in subpart B talks about, well, if you are able to practice, what are your duties and responsibilities? Because it is a big responsibility to practice before the IRS. And subpart C talks about, well, what if you don't uphold your duties and responsibilities? What are the sanctions for violations? What are the penalties? So as tax preparers, we could be subject to penalties and sanctions. It's not just the taxpayer. So we're going to talk about what that means, because the taxpayer has responsibilities, and they look to us for advice, but we also have responsibilities. And if we don't meet those responsibilities, if we do violate the regulations, there's going to be some sanctions. Subpart D is going to focus on if there's disciplinary proceedings. And that's actually a fairly long section that talks about the process and the rules that apply to disciplinary hearings. And then subpart E is the general provisions. So that's the 5 key sections of Circular 230. So again, that's the regulations that govern practicing before the IRS. Now you've probably gotten emails, and at the bottom you'll see there's a paragraph that quotes a section of Circular 230. So you're probably familiar a little bit with Circular 230. We're going to talk a bit more about what that means today. So what does it mean to practice before the IRS? So if you prepare, okay, to be practicing before the IRS, if you prepare a tax return or an amended tax return or a claim for a refund, that is one aspect of practicing before the IRS. So what does that mean when we say we prepare a tax return? So for example, an individual tax return is Form 1040. So when we say we're going to prepare a tax return, right, we're trying to determine whether or not we're practicing before the IRS. If we prepare a tax return, then we're practicing before the IRS. Some of the popular forms that are on our course website are 1040, which is individual, 1065, is the tax return for partnership. $11.20 is C Corp. So it's important to make a distinction between C Corp and right, S Corp. So 1120S is the form that we use to file S Corporation tax return. Now, what does that mean when we say individual? Oh, and also it says if we file an amended return, which, so for example, for the individual is 1040X. So sometimes you admit something. Sometimes you make a mistake. These things happen. Even as a tax preparer, we could make a mistake. If we make a mistake, then we need to correct it by filing an amended return. Sometimes it's our fault, sometimes it's not. We're not private investigators as tax preparers. We use the information that's provided to us by the taxpayer. So if they forget to give us the, let's say, Social Security card for one of their children, or they forget to tell us that they're supporting their parents, then the tax return will need to be amended. Do you know that you could claim your parents as a dependent even if they don't live with you, if you're providing for their support? So they don't need to live with you. Very often people think that, well, it's only people who live with you. But for parents, Congress has written into the IRS code specifically a unique situation whereby your parents don't need to live with you, but you provide a significant percentage of their support and they can be your dependent. Now, that only applies to your parents. So it's a very unique situation, because other persons that we might claim as a dependent would have to live with us, and there's other criteria, but only your parents would be in that unique situation where potentially they could be a dependent even though they don't live with you. So, you know, often we talk about the household test. This is a unique situation as it relates to parents. So, who are these individuals that are going to prepare a 1040? Or maybe we're going to prepare their 1040. So we need to determine what their filing status is going to be. So a significant determinant of the taxpayer's obligation, so in other words, a significant factor that's going to influence how much tax the taxpayer has to pay, is determined by their filing status. We as tax preparers need to determine that, not the taxpayer. So they really don't know, which is understandable. So filing status. So one filing status is single. So we could file as single. We could still use this form 1040, or we could use form 1040EZ. But let's say we're going to use form 1040. So 1040EZ, as it sounds, is, you know, like the abridged, the modified tax form. So we might file as single, or we could file as married, filing jointly Or you could file married filing separately. Sometimes we joke and we say married filing single, but you can't be married filing single, but in effect, so if you're married, you have to decide with your spouse whether or not you're going to file a joint return, which means you and your spouse file one return that combines your total income on one return, and you get one refund check, and you fight over who gets what. Or you could file married filing separately, and you each file your own return. You need to decide amongst yourselves, for example, who's going to take a deduction for children. The IRS doesn't get involved in that. You have to agree. They're not, whoever files first is going to get it. Yeah, so you need to agree. You need to agree with your spouse if you're going to file separately. How you're going to do that? So you could file, we said single, married filing jointly, married filing separately, head of household. So head of household basically means what? That you're single and you have a dependent. So you're not married, because if you were, then you would file as either married filing jointly or married filing separately. But head of household is a unique situation, a unique filing status that recognizes that there are people that are single and have a dependent. Then the filing status would be head of household. Now, if you're head of household, then the tax obligation is going to be less than if you were single and didn't have any dependents. So does that make sense? Because you are you're able to get personal exemption for your dependents. So that's what we mean when we say we have a dependent. Well, what's the benefit of having a dependent in terms of taxes? Is that it's going to reduce your tax obligation. So it's going to ultimately reduce your level of taxable income. And then you might be widow or widower with a dependent child. So we need to decide on what our filing status is going to be. We're going to come back later on in the semester and talk about that in a lot more detail, but this is a good point for us to get an overview and a little bit of a foreshadowing of what's to come. So all of that is in our study units and also in publication 17. Now another form, and these forms are on our course website. I hope you saw the links for those. You could download the PDF. 1065 is the return for a partnership. 1120 is for a C corporation. And 1120S is for a Subchapter S corporation. Why would you want to be a Subchapter S corporation? Because it's a corporation, it is a corporation, which has certain advantages. What are the advantages of incorporating? Why would you want to incorporate instead of being a sole proprietorship? Liability, yeah, Tanya, right?
Limited liability.
Right, limited liability, which means what? Yeah, so there's that corporate shield, that corporate veil that can't be pierced unless you do something that's criminal, that's really egregious, harmful to others. Otherwise, if you're an executive for a company, the obligations of the company are not yours. So the company owes $850,000 for inventory, not Tanya. Even though you're going to sign, you might sign off on something. Remember this too, if you sign anything, sign as president, manager, whatever it is that your title is. All right? You're signing on behalf of the company. The company owes the money. If the company can't pay, then
you just say as agent for.
Yeah, well, you could just sign your name and then write president or manager, whatever your title is. So if the company has an obligation, that's the company's obligation, not yours as the executive, as the manager. That's not your personal obligation. So if the company can't pay, they can't say, well, Renee, we know that you have a Lamborghini that's new and that you purchased for $480,000. Then you should just sell that, and we'll, take the money that you get from the sale to pay for the inventory. And then you're like, oh, homie, don't play that, right? No, that's not your responsibility. Even if you're a shareholder, Of course you have shares in the company, but you're not personally responsible. That's the advantage of being incorporated, is this idea of limited liability. Now, if you're a sole proprietorship, if you're not incorporated, and you sign, and they bring $20,000 worth of beverages to your store, that's you. That's all you right there. And if you don't pay, they could ask for your car, your house, other assets, money that you have in the bank. Now, it's up to the courts to decide whether or not they would award those assets, but you expose yourself, right? There's a risk. You can incorporate very easily with the Department of State. If you need any help, I'd be delighted. Literally, it's 2 sides of a page. The cost is minimal, right? You're talking about a few $100s to incorporate. Now, people charge $2,500, $3,500, $5,000 to incorporate, which is quite a racket. But if you have a business you want to incorporate, I'll help you with that. No charge. That's just a perk of being a part of this team. Now, what is one of the disadvantages of incorporating? Because, it sounds a little too good to be true, right? There's, limited liability, right? You walk away with all this inventory for apparel. You got all this True Religion jeans and diesel jeans and these Air Jordan, right? All this inventory for your store. So, what's one of the major disadvantages of incorporating? So certainly one of the major advantages, right? We're not going to list them all, but certainly one of the major advantages is limited liability, and one of the disadvantages is what?
Double tax.
Yeah, double taxation. So who could explain what that means when we talk about double taxation? So double taxation suggests that the company has a certain amount of profit. Now, that profit is going to be taxed. So, what's left after that profit is taxed? The company can either do one or two things. It can either keep it as retained earnings, and then that retained earnings they could invest in a new manufacturing facility or equipment, whatever they so desire. Or, instead of keeping it as retained earnings, they could pay dividends to their shareholders. A novel idea, right? Why not? Now, what happens when that money is paid to the shareholders? then the shareholders have got to pay tax. So we're talking about the same money being taxed twice. So we have let's say $100,000. We pay tax 40%. So what's left? $60,000. Then that $60,000 could either be kept as retained earnings, or we could use it to pay dividends. Now remember, we started with $100,000. We paid the tax. The company paid $40,000 in tax. We have $60,000 left. So this is $60,000 after taxes. This is what's left after we pay taxes. Now we decide for our corporation here that we're going to distribute the after-tax proceeds to everybody here, right? We're all shareholders in our company. We're going to pay a dividend, and when you get that $60,000, when we pay out that $60,000 to the shareholders, well, then that's going to get taxed. Well, this is what's left after the, this is the tax, 30%. So that's 18,000. This is after tax, $60,000 after tax. Now what we're going to do is distribute it to our shareholders. So when the shareholders get the money, then they pay tax. But wait a minute, you said, Coach, you told me you said after tax. Like I know, before and after is a difference, right? What's going on here? Are you serious? Seriously? Yeah. And that's the way it is, whether it's General Motors, Pfizer Pharmaceuticals, there's double taxation. So Congress says, well, yeah, we don't want to discourage entrepreneurship. In fact, we want to encourage entrepreneurship, and we want to stimulate the formation of small business. So we're going to give corporations the option to elect S Corp status. So this has nothing to do with the Department of State. So what happens first? You file for incorporation. Then, as a corporation, you can elect S Corp status with, this is with the Department of State, and this is with the IRS. To be an S Corp, you have to have 100 or less shareholders. So you're a small company. 100 shareholders is really not a lot. Most large companies have millions of shareholders, literally millions of shareholders. I mean, companies have market capitalization in the hundreds of billions of dollars. So they have millions of shareholders. If you have a company that's incorporated that has 100 or less shareholders, right, that's one of the main criteria, then you could, it's likely that you can get S Corp status. What's the advantage of S Corp status? Is that your corporation becomes a flow-through entity. That means that the company doesn't pay any tax. The profits flow through to the shareholders. The company is going to file a K-1. The K-1 is going to list all the shareholders. It could be 5 shareholders. It could be 50. But it's got to be less than 100. That's one of the main criteria to be eligible for S-Corp status. List the people and their social security numbers and what the distribution was. So how much do they get in dividends? Is it 5,000? Is it 50,000? That's reported to the IRS. Questions about that? So think about whether or not that's going to be feasible for your business. So to go back, how do we know if we're practicing before the IRS? Well, if we're preparing a tax return or an amended tax return, or we're making a claim for a refund, we're practicing before the IRS. If we're communicating with the IRS on behalf of a taxpayer, we're practicing before the IRS. If we're giving advice, right? If we're giving advice to a client with regard to the preparation of their taxes, then that's considered to be practicing before the IRS. If we're attending hearings and proceedings on behalf of a taxpayer with the IRS, or meetings with the IRS, then we're considered to be practicing. And we're going to see why that's why we need to make that distinction, why Circular 230 makes that distinction about whether or not we're practicing. Because if we're practicing, then we have certain obligations and responsibilities and duties. So that's why the first part of Circular 230 maps out what it means to be practicing before the IRS. So any questions about that so far? About the key aspects of practicing before the IRS? Now, if you don't prepare substantially, right, the tax return, that's not practicing. So you need to prepare to be considered practicing. You need to prepare substantially all of the tax return to be considered practicing. So what does that mean? So for example, if the taxpayer needs to have a 1040 form complete, and a Schedule A, which is itemized deductions, and Schedule B, which is interest and dividends, and other schedules like Schedule C or D, D is capital gains and losses, then let's say you only fill out on behalf of the taxpayer Schedule D. That's not substantially preparing the return. So just because you touch the return or something like a photocopy, a lot of students that do internships, they are concerned about this issue. Like, what is their obligation? So you did some data entry. Very often you probably just photocopied the return. Some of these corporate and partnership returns, I mean, the return is like this. I'm not even kidding. When I say like this, I mean like from the floor up. Can you imagine? You think I'm joking? I'm not talking about a return that's, 10 pages. I'm talking about like this, like 6 feet tall is the tax return. So, well, somebody's got to copy that stuff, right? It's not going to be the partner. So then students are wondering, like, what, I did some of the data entry on one of these forms, or I photocopied something. What are my responsibilities? Do I need to have a PTIN number, which we're going to talk about in a moment. So if you're not preparing all or substantially all of the return, you're not practicing. if you provide some information to the IRS, or the IRS requests information from you, and you provide it to them, that's not practicing. So you might get a letter from the IRS, and they might say, send me the W-2 of this employee. Now, of course, you can say, I sent it already, but, you know, IRS agent calls, or they send a letter, send it to me. So you send it, of course. That's not practicing, just because you honored a request from the IRS. Or if they ask that you appear at a hearing, maybe as the person, let's say the person's employer. Or let's say you represent a charity. Maybe, you know, you might say, well, you know, I tithe, and so I gave 10% of my salary, and, you know, that's $15,000. So maybe the IRS might say, you know what? I want to meet your pastor. Now, the pastor is not practicing before the IRS. They're just asked to appear. The IRS agent's going to ask them some questions. That's not practicing. If you prepare a return or amended return, substantially, all or substantially a return, even an amended return, that's an example of practicing, right? If you're representing the taxpayer at a hearing or proceeding, that's different from if you're like a, you know, a witness. You're not representing the taxpayer. See the difference? So if you're just a witness there, they ask you to share or verify information, you're not practicing. Questions about that? All right, so let's talk more about Circular 230. So then the question is, now we know what practicing is, then the question is, well, who is authorized to practice? Olam, Camille, Tanya, Alicia, Sharon? Well, maybe. Now, first, before we go into that, let me just say, you don't need to be a CPA to prepare tax returns. Are we all on the same page there? Right? Is that come as a surprise? You don't need to be a CPA to prepare tax returns. However, a recent development, fairly recent, is that you're required to be registered. So you have to have what's called a PTIN number. So if you're preparing people's tax returns, the IRS wants to know. Now, so who is eligible to practice? Who's authorized? Well, certainly if you're a CPA, if you have a CPA license, then you are authorized to practice before the IRS. You could prepare tax returns, amend tax returns, file for refunds. You could participate and represent during hearings and proceedings. You could do all of those things if you're a CPA. If you're not a CPA, then, well, first of all, if you're a CPA and you're in good standing, okay, that's important. That gets back into the idea of ethical and legal responsibilities and duties. So you need to be in good standing. That's one group of people that are authorized to practice before the IRS. So CPA, that's probably obvious, the most obvious, right? If you're an attorney, you're authorized to practice. Now, you need to decide whether or not you want an attorney to represent you, because just being an attorney doesn't mean you're an expert in taxation. You may be a tax attorney, okay? But don't think that, well, I'm going to have an attorney represent me. Well, attorneys, there's a lot of different specialty areas. So if you're an attorney in good standing, right, you haven't been disbarred, then you can practice. Now, besides the CPA exam, the IRS will certify individuals who pass an exam known as EA. EA is enrolled agent. So an enrolled agent is somebody who's demonstrated a proficiency in the tax code. It's a very rigorous exam. It's not the same thing as being a CPA, but certainly it is a credential. So if you take the EA exam with the IRS, and you pass, that's a significant accomplishment, and you can practice before the IRS without limitations. So enrolled agent has the same authorization as a CPA, which is a much broader certification, and as an attorney. Now that's different from being certified as a volunteer tax preparer. So the IRS has a Vitis program, which is an acronym for Volunteer Income Tax Assistance. There's a number of short exams. There are 20 to 30 questions that you take online on the IRS website. It's an open book. Basically, you sit there with publication 17 and go through the questions. Because what they want to measure is your ability to find the answer. See, very often we focus on knowing the answer. That's impressive, but it's also impressive if you know where to find the answer. Henry Ford, the founder of Ford Motor Company, was once put down by some individuals. They said that he was dumb. They said he was stupid. So they had an interview with him. And the premise was, look, he says I'm not dumb. And they said, yes, he's dumb. Now can you imagine Henry Ford? So they said, all right, we're going to ask him some questions. And so they asked him some of these questions. Who was the first president of the United States? Right? Everybody knows that was Bill Clinton, right? And then they asked him, what color was George Washington's white horse? Right? He didn't know the answer to any of these questions. So they said, you see, there you go. This is what happens when you smoke too much ganja. And so he said no. He says, give me 5 minutes and I could have somebody here who could tell you the answer. He says, I don't know the answer to every question, but I know where to find the answer. I know somebody who has the answer. I know Corinne has the answer. I don't need to know that. I want to surround myself with people who have complementary skills and knowledge. That's one of the things that Jack Welch did very successfully when he was the CEO of General Electric for about 20 years, which is very unusual. At that level, usually the tenure is 2 to 3 years, 4 years, 20 years plus as CEO and also chairman of General Electric. He was proud about saying, you know what, I don't want somebody on my team that knows the same knowledge as what I have. I want to surround myself with people who know things that I don't. And that's how I'm going to be successful. And surely he was very successful in enhancing the shareholder value at General Electric. So the Vitis certification, you should do it. I think it's a good idea. It's part of your credentials. But it's not the same thing as being an enrolled agent, or certainly being a CPA or an attorney. Questions so far? No questions? Are we good? All right. All right, I want to go over a couple of questions. I'm going to read a couple of scenarios to you. These are kind of some of the simulation type questions I was alluding to before about the application of the concepts. So this is a question as it relates to aspect of Circular 230. All right, so this is the question. So it says, Sharon Cummings, CPA, represents her brother, Joe Cummings, and Joe's business partner, Bill Smith. Okay, so Sharon represents her brother's business partner. Now, Sharon and Bill Smith are equal shareholders in Joe and Bill Corporation. So what do we have here? We have the CPA, right? The CPA and the client are equal shareholders in this company. The Internal Revenue Service examined the corporation and determined that one of the shareholders committed fraud, but could not determine which shareholder it was. Sharon has made an appointment with the Internal Revenue Service to determine which partner was guilty. Which of the following statements reflects what Sharon should do in accordance with Circular 230? So what's the issue here? Conflict of interest. So one of the things that Circular 230 talks about is the issue of conflict of interest, which, do you agree? There seems to be a conflict of interest here. So if we look at section 10.29 of Circular 230, that's where we'll see the discussion about conflicting interests before the IRS. So in this situation, what should Sharon do? She should tell Joe and Bill, right? Those are the ones that are equal shareholders in this company, that she can't represent them because there's a conflict of interest. So who could tell us what's the nature of the conflict of interest based on what I just shared with you? Why is there a conflict of interest there?
Because you want to share your message represent.
Because his brother is part of the scheme with the other partner, and then she would tend to support kind of the brother, like they think pretty well the brother.
Yeah, so there's an issue of fraud, and so Sharon, her brother, is a partner in this company. It doesn't tell us in this scenario that she represents her brother, she represents the partner. Now, how could the guy get a fair shake, is what you're saying, right? If you're going to appear before the IRS, well, it's likely, I mean, don't take this the wrong way, that, you're going to look out for your brother. You're not going to say, yeah, my brother, yeah. It was him. He's the one. He's guilty of fraud. Yeah, so we have to look out for that, where the practitioner is going to be materially limited because of this conflict of interest. This happens very often. It's very common that there's a conflict of interest we need to be sensitive to that. We need to be aware of that, that there is these conflicts of interest, and we need to recuse ourselves and say, I'm not going to be able to represent you because my brother is also a party to this matter, and so there's a conflict. I can't represent you fairly, I mean in all candor, because I'm not going to sell my brother down the river. I mean, you might want to, but it's unlikely.
So how come it's not a conflict of interest if you're paying the taxes?
Well, that's another issue. So what do you think? So is there a conflict of interest in preparing the tax? So the petitioner's brother and another individual are partners in a company. Is there a conflict of interest, or is the tax return going to apply equally the impact, in other words, the tax liability, to both shareholders? Because they are 50-50 partners in this case. So one is not disadvantaged. Both would be 50-50, right? Both are 50% responsible. So in this case, one wouldn't be disadvantaged. Now, there could be other scenarios that we could talk through where there could be a conflict of interest, but whatever the practitioner does, there's really nothing that she could do that would favor one partner over the other, even though one is her brother.
And if she tries to defraud by some benefit to the company, she has to sign it to return. So anyway, in either way, if the IRS comes after them, they're coming after her also because she signed it.
Yeah, so keep in mind that there's been this paradigm shift. Tax preparers historically have felt that if, let's say, for example, a person's tax return is audited, that's the responsibility of the taxpayer. But what's going to happen is, on closer examination, is the role of the practitioner is going to also be examined. So the IRS is very interested, more so now than ever, as to whether or not the practitioner did something that was unethical or illegal. Now, interestingly, of course, taxpayers, they feel like, oh, I didn't prepare the return, that's why I hired Sharon. But the IRS also says, well, wait a minute, we were born at night, but not last night. They're like, well, you can't blame everything on Sharon. She just put down what you told her. And you also signed the tax return. So if you didn't agree with what's on the tax return, then you shouldn't have signed it. So if she put down that you have 6 dependents and you only have 1, then why did you sign the tax return? But still, for us as practitioners, we need to be cautious, and the IRS really wants to discourage practitioners from being creative in their interpretation of the tax code. So there is some areas that, especially as technology advances, things change, that some aspects of the code can be considered gray. But for the most part, tax code is quite well articulated, and you could argue that some things are subject to interpretation. Then you need to be able to explain your point of view to the IRS, why you feel that way. And it might turn out in your client's favor. Sometimes it's actually quite common that you get what's called a letter audit, which is basically you get a letter in the mail from the IRS. That means you're being audited. That's what that letter is. That means there's something on your return, and they'll mention that in the letter as to what they feel is inconsistent with what they have in their database. So the W-2 that you get from your employer, they have that in their database. They know. You can't say that you made $10,000 less than what you did, and you have a mortgage, you get a 1098 from your bank regarding your mortgage, and it says how much interest you paid, right? That's your interest on your mortgage is an itemized deduction. So if you actually paid your mortgage company $18,000 in interest, you're probably thinking, taxpayers are probably thinking, well, I'll just make that $28,000 and significantly reduce my level of taxable income. And so that's not a good idea. All right, because remember we were talking about in terms of integrity? First of all, in terms of integrity, you do what's right even if nobody's looking. That means even if you think that you could get away with it, but of course you never do. And the other thing is that you're going to get busted. Why? Because they have a copy of that 1098. The mortgage company provides them with that. They know how much your mortgage interest is. They know how much you received in wages from your employer. They know how much interest you received on your bank account, savings account, checking account. They know when there's capital gains distributions on your mutual funds that you have with a brokerage firm. So it's our responsibility as a practitioner to make sure that the taxpayers' information is accurately recorded on the tax return form. And there's a shared responsibility there. Like I mentioned before, there's a lot of finger pointing. Well, you prepared it, yes, based on the information that you provided to me. Right? So you gave me a Social Security card. And you said, I didn't know that was your neighbor's kid. You gave me the Social Security card, and you told me you provided more than 50% of the child support. You know, how am I supposed to know? I thought that picnic was yours, but it turned out that it wasn't. But, and I thought not only that, but I thought that you did provide a significant percentage of the child support, whether it was your child or not, which is key. All right, let's look at this situation. Mike is a CPA with Widget Company, which is an accrual basis taxpayer. What's the difference between cash basis and accrual? Who remembers?
Accrual is cash.
Wait, who's talking?
Cash is when the sale is right there, and accrual is when like accounts receivable.
It could be in that situation, but let's expand upon that.
Cash based is when you actually pay the cash, or when you actually receive the revenue, or the check, or the cash. That's when you recognize it. Under accrual based, you recognize the expense when you actually incur it. May not necessarily mean that you already paid for it. Same thing goes with revenue. You may provide a service that, and you're expecting the cash or the check to be received. You cannot recognize it at the point when you actually provided that service. So it's the differences between when you recognize the revenue.
Yes, everybody got what Muhammad said?
Yes.
Cash basis is you recognize the transaction, whether you're receiving payment or you're making payment, you recognize the transaction when you receive the cash or when you pay the cash. Whereas accrual, Muhammad explained very clearly, an accrual basis of accounting is, well, we may not have paid the bill yet, but we either perform the service and are entitled to payment. So like you're saying, it's an account receivable, right? They owe us the money, so we record that transaction. Or even if we didn't pay the electric bill yet or pay for the inventory, it's an account payable. And so we record it at the time that either the service was performed or that the obligation was incurred. But we didn't pay yet, but we need to accrue for it. That's what accruing accounting, accrual basis suggests, is that at that time, we may not pay for it for 30 days. In fact, very often terms are 210 net 30. So you don't have to pay, even they don't even require you to pay in 30 days. Sometimes when things are not great in the economy, maybe they'll give you 60 days. So you wouldn't have to pay for 60 days, but you're going to recognize it under, if you're following accrual basis, you're going to recognize it at the time that the obligation was incurred. So this firm, this widget company, is an accrual basis taxpayer. And in year 3, this is what happens. In year 3, while preparing widget's year 2 return, so after the year closes, then, and you're ready to prepare the tax return, Mike discovered that widget failed to include income on its year 1 return that widget received in year 2. So that's why we talked about the difference between accrual. Well, in year 1, we should have accrued that money. We should have accrued that money, even though we didn't receive it until year 2. So with accrual basis, there was income in year 1, even though we didn't receive the money. Because we're doing accrual basis, we should recognize, as Muhammad said, we should recognize that income. But not only didn't we do that, but we found out that this was a mistake, right? So it was in year 1, there was income that wasn't recognized, that wasn't reported, and we're preparing the tax return for year 2. So the question is, what should the CPA do? Natasha? So what should the CPA do? Because one of the things that, you know, after what we just talked about the duties and responsibilities, one of the things that we start to get anxious about is, now that we realize that, okay, we're a CPA, we realize that there was income that wasn't reported. So maybe our gut instinct is, we need to tell the IRS. That's maybe your gut instinct, but is that right? What do we need to do as a CPA? Do we need to tell the IRS?
You should tell your client.
Yeah, you need to tell the client.
And
Absolutely.
you give them the option of making a decision as to whether they want to report the income. And if you think that it's a reasonable amount, at that point you can decide whether or not you want to represent them if they say no. Because they can say no, they don't want to report the income because they don't want another tax liability.
Yeah, so you need to, I'll paraphrase what Tanya's saying. Essentially, once we find out that there's income that wasn't reported because they didn't tell us, so that's their bad, it's not our fault, they didn't tell us, then we need to tell the client right away, and we need to make them aware of the consequences. Because you can't just not pay, right? You can't just not report income, and there's penalties. And depending on how much income was not reported, the IRS code is quite severe in terms of the penalties. You know, you can't not forget to pay report $500,000 in income. They don't think that's funny. Not at all. So you need to tell the client, you need to tell them what the consequences are, but as a CPA, you don't need to tell the IRS. That's you don't need to drop the dime on on your client. That's not part of our duties and responsibilities. Our obligation is to tell the client and to let them know what the consequences are. How are we doing on time? I think we got like 2 more hours. What? It's until midnight, right? All right, let's see, a few more, then we'll wrap up. And then, presumably, Tanya, we're going to do an amended return to address that issue. All right, let's see here. All right, here's a question about written advice. So the question says, written advice prominently disclosing, because we can give different types of opinions. That's what the clients want us to do, is to provide an opinion. Written advice prominently disclosing that it was not intended by the practitioner to be used, and that it cannot be used by the taxpayer for the purpose of avoiding penalties, which is what? That's a direct quote from where? Yeah, when in doubt, just, yes, circular, it's got to be circular 230, right? As it relates to this issue. And that's what you see at the bottom of these emails, is something to that effect that says that that email is, whatever it says in that email, the reason for that email is not so that you could avoid paying penalties. Because say, well, you sent me an email that said, listen, I can't undo the penalties. Maybe I can help keep you out of prison, but the penalty, I can't, it is what it is. So don't think because, oh, you got an email from your CPA that somehow that means you don't have to pay the penalty. Even if you get an extension of time, that doesn't mean that you're exempt from paying a non-filing fee, right? So you get an extension of time, but you still didn't file. Now the IRS says, okay, we'll give you an extension, but you didn't file your return. And there might be interest and penalties associated with the money that you owe. So that's a part of Circular 230, which says, let's just all be on the same page here. Don't think because I sent you this email that that's going to exempt you from any penalties. And it says, all right, so let me read it from the beginning. Written advice prominently disclosing that it was not intended by the practitioner to be used and that it cannot be used by the taxpayer for the purpose of avoiding penalties that may be imposed on the taxpayer is reliance opinion, market opinion, either a reliance or a market opinion, or neither a reliance nor a market opinion. Wait, I think I heard it. Who said that? Tamara Scarlett. I got it. Right, it's neither. It's neither a reliance or a marketed opinion. So what is a reliance opinion? Yeah, you're in the right direction. So a reliance opinion is an opinion that suggests that there's more than a 50% likelihood that the matter is going to be resolved in the taxpayer's favor. That's considered to be a reliance opinion. Keep in mind, you have to be careful what you tell clients and also what you tell them, communicate with them in writing. Because their advocate, right? You're representing them. But there's also this adversarial relationship because somebody is going to ultimately be responsible. And the taxpayer doesn't want it to be them. So the first thing that they're going to pull out is one of those emails that says, you said, and you're like, yeah, but, hello, whatever I said, let's be clear, that does not exempt you from the penalty. All right, so if it was suggested in the opinion that there was more than a 50% likelihood that one or more of the tax-related issues would be resolved in the taxpayer's favor, that is a reliance opinion. Because there could be multiple issues. Very often there are multiple issues, especially once you start to go, down that pathway where you have unsubstantiated, let's say, deductions, for example. Keep in mind when you itemize deductions, it's not enough to have an invoice. People think, oh, anybody can, you want invoices? I can give you all the invoices you want. No problem, man. All the invoices you want. The IRS says, well, that's interesting. I mean, yeah, but the only thing that really is going to impress us, because we believe you, we do believe you, we believe, the IRS says, we believe taxpayers, but we would believe you a lot more if you could provide us proof of payment. If you had a canceled check, right, that said that you paid that amount in charity. So keep that in mind. It's not enough to have an invoice. You got to show that there's proof of payment. So canceled check, think about it too. Not just a receipt. Better off write the check instead of giving somebody $500. Write it in a check. If the IRS audits you, and it happens all the time, when you get that letter, you're being audited. Usually it can be resolved very simply. Just, they might just say, well, send us a copy of the canceled check that shows that indeed you did donate $15,000 to this charity. That's definitely going to enhance your credibility with the IRS. All right, so the next question that we're going to look at talks about disreputable conduct. So the question is phrased, which is not an example of disreputable conduct from Circular 230, which is in section 10.51. Knowingly giving false or misleading information to the Treasury Department. Is that an example of disreputable conduct that can cause a CPA to be suspended or disbarred from practice before the IRS? Knowingly. So you're a CPA, you're practicing, you're authorized to practice before the IRS. And what do? You knowingly, you know that the information that you're providing them is false and you do it anyway. Oh, you get time out. Big time. Willful failure to make a federal tax return in violation of federal revenue laws. So that means that you didn't prepare the tax return when you knew that money was owed to the federal government, to the IRS. That's bad. How about this? No big deal. Misappropriation of funds. It happens all the time, right? Received from a client for the purpose of payment of federal tax. So in other words, the client owes money. In their infinite stupidity, what do? They give you the $10,000. And then what do you do with it? Right. What do we learn? In economics, you could either save or spend. Right? So you get $10,000 of your client's money. That's it. you spend it. Now, we chuckle about it, but these things happen all the time. I mean, it's alarming. So, it's serious. I mean, I don't need to give you any ideas, you know, but this is definitely a concern. What about this one? Let's see. Failure to respond to a request by the Director of the Office of Professional Responsibility to provide information. So, they ask you to provide information and you don't. Is that going to get you suspended or disbarred? No. That's, I mean, certainly compared to the other things that we mentioned, it's not as serious, and you won't get disbarred for that. Okay, here's an interesting one about tax return preparers from section 1.3 of the study unit 1. A CPA must sign the preparer's declaration on a federal income tax return. So remember, we were talking a little bit before about signing. So the taxpayer signs and the CPA has to sign in which one of these situations? Only when the return is for an individual or corporation. Well, that's almost all of them. Yeah, of course they need to sign, but it's not only if it's a partnership, yes, or if it's not just a C Corp, S Corp. So you would need to, not only for those two forms, entities, whenever the CPA prepares a tax return for others. So if a CPA prepares a tax return, do they need to sign it? Well, let's see if there's a better answer. Only when the CPA can declare that a tax is based on information of which the CPA has personal knowledge. No, that's, that wouldn't require them to, that might actually be the case, but that wouldn't be what would require us to sign a return. And then the other choice is, well, only when the CPA prepares a tax return for compensation. So which one is it? A CPA must sign the preparer's declaration on a federal income tax return only when the CPA prepares a tax return for compensation? Yes, that's the requirement. If you prepare a tax return for compensation, if it's a CPA prepares a tax return for compensation, then they are required to sign the return. So if you're not getting paid, then you don't need to sign. So when you're a CPA and all your friends want you to prepare their return, you're like, it's all right. Consider it a favor. Actually, it always becomes very problematic when you prepare tax returns for people that you know, because whatever it is, it's always going to come back on the practitioner, right? It was you. You're like, you told me, right? So you can't win. All right, any questions so far?
Who's going to sign it then if the CPA doesn't sign?
Well, the Circular 230 says that if you're a CPA and you prepare the tax return and you're not being compensated, then you don't need to sign the preparer's declaration. The taxpayer still needs to sign. Taxpayer always needs to sign, but below the taxpayer's signature is the preparer's declaration that says, right, that's when you're like saying that I believe the information provided here is accurate, even though, I mean, we only know what we're not required to do an investigation. This is what the taxpayer told us based on that information. And so we signed that we prepared it and we were compensated for it. So if we weren't compensated, then we don't need to sign the declaration. Taxpayer always needs to sign.
Yeah.
Questions? Other questions? So we'll resume next week. Sound like a plan?
Yes.
All right, you guys are awesome. Fun times! Woo-hoo! All right, so have a good night. We'll see you next time. Same bat time, same bat channel.
Same bad
Right?
place.
Exactly. This is the place to be.